everyone, welcome to my channel. I'm Chairini and you can call me Rini. I'm MBA student of IPMI International Business School. Today I would like to present about corporate finance mind mapping. This video is made to fulfill the assignment of corporate finance course led by Professor Sembel from the week 1st until the final week. So let's get started. Okay, in the first week, we learn about financial management. What is financial management? Basically, financial management focuses on decision making with special attention on creating and maintaining wealth. Financial management also deals with the creation, maintenance, and enhancement of economic value or wealth. So there are 4 objectives for financial management. The first one is basic objective, operational objective, social objectives, and research objectives. We also learn about 4 cornerstones of the corporate finance, which include core value of principal, conservation value, expectation treadmill, and the best owner principle. So what is the goal of the financial management? There are 2 goals that we want to achieve in financial management. The first one is to maximize profit, and the second one is to maximize the shareholders' wealth. After that, we learn about the GCG principles. We call it tariff, stands for T for transparency, A for accountability, R responsibility, I independency, and F for fairness. And then we also learn about the time value of money. What is the time of value of money? So the illustration is, if we receive $1 of money today, it is worth more in the future due to the opportunity cost. So the opportunity cost of receiving $1 in the future is the interest we could have earned if we had received the $1 soon. So don't forget also about the 5 business essentials from Professor Ramcharan, which consists of cash, profit margin, velocity, growth, and customer focus. And after that, we also learn about Rule 72 in deciding to calculate about the time value of money. What is the Rule 72? The Rule 72 is a simple way to determine how long an investment will take to double given a fixed annual rate of interest. By dividing 72 by the annual rate of return, investors obtain a rough estimate of how many years it will take for the initial investment to duplicate itself. And after the end of the class, we divide it into 5 groups, and we have to make an investment simulation based on the shares stock that we choose. So that's all for the first week. And in the second week, we learn about capital budgeting. What is capital budgeting? Capital budgeting is planning process for investment in long-term assets. So the concept of capital budgeting is estimated expected future cash flow, evaluate the project-based capital budgeting, decide whether or which project is good or bad. 2 or more projects can be mutually exclusive, may choose only one, or independent may choose all good projects. So the methods of deciding capital budgeting, there are 4 methods. The first one is payback period. This means how many years does it take to cover the initial investment. And also we have net present value. The rule is accept if net present value more than or equally 0. And the third one is profitability index. And the rule is accept if profitability index is more than 1 and reject if PI is less than 1. And the last one is IRR, which means internal rate of return. This is the return of the invested capital. So the rule is, if IRR more than required rate of return, accept the project. But if IRR less than required rate of return, reject the project. Alright, let's move to the third week. In the third week, we learn about the analysis of securities. which is consists of 3 points, namely the first one is fundamental analysis, second one technical analysis, and the last one is market or investor sentiment. So what we learn in the fundamental analysis? In fundamental analysis, we learn about the macroeconomics. So the framework of the fundamental analysis is domestic and global economic analysis, and then followed by industry analysis, and the last one is specifically to the company. In fundamental analysis, we also learn about how to understand the financial ratios, which is there are 4 financial statement analysis that we have to analyze. The first one is the profitability ratio, or the example, the return on asset and the return on equity, and also liquidity ratio, which is consists of quick ratio or cash ratio, and activity ratio, which is current asset ratio or a fixed asset financial ratio. And we'll also learn about the leverage ratio, which is consists of debt to asset ratio and debt to equity ratio. And we have to analyze about the market ratio, which is dividend yield, price earning ratio, and so on. So the profitability ratio, meaning that we have to measure the overall effectiveness of the firm's management. Besides that, liquidity ratio is used to measure the ability of a firm to meet its short-term financial obligation. And then efficiency ratio. This provides basis for assessing how effectively the firm using its resources to generate sales. And the last one is leverage ratio. This used to measure the extent to which non-owner supplied funds have been used to finance the firm's assets. We also learn about the DuPont system. The DuPont system summarizes key relationships which determine the overall performance of the firm. And how about the technical analysis? So the technical analysis is finding repeated patterns in the price graph, which is include momentum versus reversal, trend, uptrend or downtrend, support resistance, triangle, is it symmetric or asymmetric, moving average, and filter wall. And also, we learn how to calculate average stock returns, which is variance and beta, total risk, systematic risk, unsystematic risk, and CAPM. Okay, and after that, in the 4th week, we learn about capital structure. There is also a theory to how to optimize the capital structure by Modigliani and Miller. So Modigliani-Miller theory consists of assumptions. The rule is no transaction costs, no taxes. Everyone has same information and borrowing rate. Debt is risky. Debt doesn't affect operation. And Modigliani and Miller also wrote an important paper in 1958 in which they prove that with tax deductibility of interest payments, the optimal capital structure is 100 debt. So there are also factors that determine optimal capital structure, which is tax benefit and expected cost of financial distress. In the 4th week, we also learn about the corporate restructuring. This topic we learn by watching movie. So we are divided into 4 groups, and each group have to watch the movie and make the summary what the movie is all about and what is financial issue and lesson learned that we got after watching the movie. And our group choose the Others People Money, which is the story is about merger and acquisition by using leverage buyout. And also we learn about the RGR Nabisco. This is one of the example of the leverage buyout cases. And Professor Sembel also give us assignment to make a book review. And our group review a book, Random Walk Down Wall Street, written by Burton J. Malkiel. Alright, that's for the 4th week. And we move to the 5th week. So in the 5th week, we learn about the fraud risk management. In this course, we learn about whistleblowing. What is whistleblowing? Whistleblowing is an act of reporting misconduct to managers, executive or other authorities with the power to take corrective action. So whistleblowing tool is empower employees to identify the wrongdoing and to protect the integrity of the organization. All right. And the next week, we'll learn about the dividend policy. The dividend policy involves two decisions. The first one is how much of the firm's earnings should be distributed to shareholders as dividends, and how much should be retained for capital investment. And in the final week, we'll learn about the international business. The international business, or sometimes known also international macroeconomic, is the study of monetary transaction between two or more countries, focusing on areas such as foreign direct investment and currency exchange rates. We also learn about efficient market hypothesis in the final week, which is we already summarized this point in the book review of A Random Walk Down Wall Street. So based on the efficient market hypothesis, the market is efficient in the way that is reflecting all currently available price information. If there are obvious opportunities for return, people will flock to exploit them until they disappear. This theory suggests that technical analysis can be used for beating the market, but that fundamental analysis might be able to. So I think that's all of what I have learned from corporate finance class in a very short week. The learning process is very fun, interactive as well. Every students are encouraged to give an opinion and dare to make mistakes. We also have been given so many assignments from book review, movie review, until video presentation of IPO analysis. But from that, I've got so many insights, new knowledge about investing, and all related kind about financing stuff. So guys, I hope this video is useful, and don't forget to give likes, comment, or subscribes. I'll see you later. Stay healthy and bye-bye.